Hello everyone, it's Hiên Nguyen from ST Consulting. I'm back. Today I'm going to share with you my view and my analysis a little bit about what is going on in our world right now, okay? I'm going to focus on the three angles. The first, I'm going to list out what is happening in our world in the last 1 year, especially in the US, okay? And also each of the event, what the reasons behind that. And then the second area I'm going to talk about is the consequences of what we face from all these events and also the lessons we learn from this. And then the final one is that I'm going to share about what my opinion on what we should do right now to deal with this situation, with the mess we are facing at the moment, okay? So let's dive into the topic. So US is the biggest economy in the world, and anything happen to its well-being, it will affect all of us. So because of that, I'm going to focus on the 5 biggest events in the US in the last 1 year. Okay, the 5 biggest events are the inflation top up, and then the collapse of the 3 banks in the last few months, and then also the US debt ceiling alarm recently. Okay, so first is about the inflation. Inflation top up last June, and it was 9.1%. Okay, main 2 reasons we face. The first reason is that about the loose monetary policy from the US Fed. As you can see from the chart, they kept the interest rate at the very low level compared to the last decade or so for a long time after the COVID situation. They want to help to stimulate the economy, but they did it too much, and it went to trigger the inflation situation. The second reason behind it was the disruption of the supply chain and also the bottlenecks of supply chain caused by the war between Russia and Ukraine that made the oil price increase so much. And then also the China zero COVID shutdown. So these 2 main reasons caused the inflation went up so much. But in my opinion, the first reason was the main cause for the situation. If we look at the chart of the inflation over the last 3 years, it was very low before, and then it went up so fast during the 2020 and 2021. In 2022. So here is also the interest rate chart. But you see how low it was. It's almost at historical low, and similar to compared to the after the Great Recession 2008. So next is about the collapse of Silicon Valley Bank. The 4 reasons that caused the collapse of Silicon Valley Bank was the first one was the hike in interest rate. The high interest rate caused depositors to withdraw the money to put into the money market. The second is that the decrease in the value of the assets of the bank because they put money into the government funds and also the bonds, so the value decrease. Then because of that, they faced liquidity problem, and then also they went to raise the money, and then that triggered the situation of the panic in the depositors, in the equity investors, and some of the biggest clients from the bank withdraw the money. So interest rate problem caused this bank to face liquidity problem and then panic problem. So the Another reason is that they enjoy the early time in 2018 and 19. There was relaxing in the tailoring rules for the liquidity standard requirement for small banks has a total access lower than $100 billion, and this bank was in that category. Because they enjoy the relaxing rules, so they went to do risky business. The most important reason that original of this all is the bank has the focus and concentration in one sector, in one technology sector, and especially with startups. So when the interest rates increase, the startups faced with the cash flow problem, faced with the high interest rate, and could not generate enough interest expense, and also generate cash flow to the bank, and the banks face liquidity problem with the cash flow. So these are the 4 reasons for the collapse of the SVB. So the next case is about the Signature Bank's collapse. The reasons for Signature Bank collapse that we see, they also face the same situation as interest rate, and also they enjoy the benefit from the tailoring rules, okay, with the less strict in the stress testing scenario. That's the two reasons they have the same as the SVB. However, the third reason is different from SVB, is that this bank focus on the crypto currencies, and the cryptocurrencies got crisis with the collapse of the exchange FTX, and then depositors came to withdraw a lot of money from the bank, from total $106 billion to only $80-something billion. And then when the SVB faced a problem, it triggered more depositors went to withdraw the money. Billions of dollars was withdrawn within only one day. So and also the sale of the stock shares. So it led to the collapse of the Signatures Bank. The third bank collapse was the First Republic. After the situation with SVB, there was more strict in security in the banking system, and then also many of the banks saw the liquidity problem at the First Republic Bank and went to rescue with support around $100 billion in the liquidity help. However, it still could not save the bank because it was caused mostly caused by the panic of the public because of few reasons. First, S&P downgraded First Republic to junk, and then also Moody downgraded the whole banking sector to negative. So that caused more panic in the public, and more depositors went to withdraw the money, and then also selling of the stocks. Okay, so that caused the collapse of the Republic banks. And with all of this going on, with the crisis of the banks, we don't know what will happen next, because with the panic problem and people going to do a short sale, we may face more problem going with the regional small banks in the West. One more reason of this collapse of all of the 3 banks here we want to talk about is that also maybe a little bit of the role of the auditor. Okay, the auditors of these 3 banks could not point out early or pointed out any signal of the weak of of the problems with these three banks before it collapsed. So the next one is about the U.S. cap in the debt, which is over $31.3 trillion in the cap. So there's long history of the cap set and also increase in the cap over the time. However, what trigger of the recent announcement that if there is no reducing or increasing the cap, then the U.S. government is running out of cash by June. The problems is causing this is also mainly on spending. Okay, the U.S. government is a lot more than is collecting from the money from the tax payment and also the other sources. So it's raised more debt and more. Actually, this part also one of the reasons cause inflation, because if you keep printing money to pay back your debt and increase your debt level and then keep printing money over the long term, so it causes inflation in the long term, and especially with the recent trend, okay, of the not favoring U.S. dollar on the many different systems, like even the reserve of the World Bank and many other groups that are trying to use other type of backup, like gold or the yuan from China or something. So they don't use a lot more U.S. dollar. It makes the U.S. dollar strength reduced. The currency is reduced in the valuation. Then the realization is cause what you spend more, then it will be reflecting to the inflation. So with a situation like this, they cannot stop here. They have to raise the cap to keep the continuity of the economy and everything. So that also means that in the future, yes, they will have to control the inflation of the future. And then, so what's the consequences and the lessons that we learn from all of this mess? First of all, we will have to see, the high inflation rate going on for a while. They will not be able to reduce it to the below 2% level so quickly. And that situation also lead us to face the higher interest rate environment for a period of time, for a while, and maybe a couple of years. At the same time, the U.S. government, increase the debt cap level and increase the borrowing, increase its payment back to the creditor, and then also in the interest rate environment, they have to print more money to pay back the principal money as well as to pay back the interest expense. That also causes inflation not to be able to reduce so quickly. And because of that, in my opinion, there won't be the recession coming, because if they don't let the recession to come, then the situation is going to lingering for a long time and hurt more to the economy. But we have to watch out. The recession coming, whether it is going to a very easy minor one, or it's going to be the big one lingering into the system for a long period of time, we need to watch closely to the dealing from the Fed and the central banks around the world. Actually, the situation the collapse of the banks, the weak banks, do help the U.S. government, help the Fed a little bit in terms of reducing the inflation without the need of increase the base interest rate. Because the collapse of these banks will have to reduce to have to restructure the bank system, and also the stricter rules in terms of lending out, and also reduce credit lending in the economy. However, okay, if that stop from here, then it's okay. It's have good and bad, but if it's going on forward and more banks going to collapse and it's trigger the whole system, banking system situation, and also the whole other companies in the whole economy, then the severeness of this situation is going to be out of anyone's control. Okay, we could not imagine any what will be even worse than 2008. We don't know yet. We have to look into it, to pay attention to it. Other consequences from this situation that we as people, normal people, are facing. Okay, first of all, those investors, those depositors at the banks, these banks face the loss of their money. Okay, the loss in the trust of the whole banking system and also the whole economy at the moment. The fear of the economic crisis and banking system crisis is going on. The central banks around the world worry about this situation, and they are working with the US at the moment to try to control the US dollar swap daily at the moment, not weekly before, to control the situation so that they will not cause the severe crisis into the international market. What are the biggest lessons we learn from this? The two biggest lessons we as investors and as individuals learn from this whole mess is that first one is concentration in terms of doing investment and in terms of doing business. Concentration risk is a very bad problem. And the second problem is that the severeness of the panic sentiment that could cause so much, could hurt so much to the whole economy. Too severe of the market panic could destroy anything. So, with all this mess going on, what should we do to deal with all of this? To help to protect our wealth, to help to increase, to make money in a safer situation and with better investment and better business. So what I'm going to share here is just my opinion, what we should do, okay? You don't go to act on it, on these opinions, before you study yourself, analyze yourself, carefully learn yourself, and make the decision yourself, okay? First of all, if you are a depositor, you have a lot of money sitting in the banks right now, okay? Please take into the action, diversify the money, spread it out to many banks. Don't put in one bank, and be safer. At the moment, try to avoid the small and regional banks. Okay, try to put more of your money into more the banks that have more diversification in their access. Okay, so it is safer. At the moment, we should look into the protecting the wealth, protecting money as first criteria. Okay. Second is that if you are investors, if you are not investors, please, if you do investing, then please get some help from some experts, okay? And then if you have more money at the bank right now, please also diversify, put into the money market, okay? Because the government bonds and the government notes and bills at the moment has a very high interest rate, is 5% or something, compared to the deposits that you put into the bank at the moment is less than 1%. So diversify out, make more money at the same time. Situation with the debt of the bank, the government, US will scare you? No. If the US government collapse, the whole world is going to collapse. So T-bill is still very safe one. Okay. And then if you are investors and business doer or the business making people, okay, please look into your business, look into other investment, do diversification. You look at what's the concentration cost to these banks, and it's all the old saying that our mothers teach us: don't put all the eggs in the one basket. But we sometimes just forgot. Okay, diversification here. I'm not just saying about putting the money or investing into the different sectors in one economy. Diversification here, I'm talking about diversification internationally. Diversification into the markets that have lower correlation with the US and Europe right now. Okay. One example I can share with you is the Asia markets. You can look into the Asia markets. And as you can see here, the Asia markets in 2023 are going to contribute the majority of the world growth in GDP. Okay, so that means that what's going on in the US and Europe, that either get negative growth or very low growth rate, is not much affecting what is going on in Asia at the moment. So that also means the correlation between these economies and the Europe and US is very low. In that case, when you diversify out your investment, your business, it will help you to perform better and with lower risk. Okay. And I'm going to share with you, okay, one analysis result. I'm going to share the analysis for the China market and also the US market, because US represents the number one developed countries. Okay, China represents the number one Asia and also emerging countries. So this the correlation between these two represent what the correlation between the developed markets and the emerging markets and also Asia markets. The group of 5 researchers at one of the universities in China did research, okay, over all the big events from the recent years. What they study including global financial crisis, trade war, SARS, COVID-19, and so also the bull market during after COVID. Okay, so they published the results as the end of last year, 2022. The results they show that in normal bull market, the correlation between the US and the China markets, stock markets, is very low, like around 0.2. Okay, and during the negative national events like global financial crisis 2008 and trade war and SARS and COVID, then the correlation is even negative. So what does that mean? That means when you diversify between these two economies, you get a lot of benefits when it comes to the negative national events like what they study. So even if we don't need to look at the study like it, we look at what is going on in current situation. Not many emerging countries in Asia are affecting so much by what's going on in the US and the Europe. Even though we see, of course, there is always a negative effect, right? But it's not like going to be severe. So that also means have you to reduce your correlation and increase your diversification into these markets. Help you to reduce the risk and also increase your profit and protect your wealth as well. Okay, to protect your business as well. Of course, when you invest internationally, each market you will face with different type of risks as well. So if you are not familiar with other markets risks, and if you are not investors that specialize in investment, then you can get help from experts and also from the local markets experts. Like for example, if you want to look at the emerging market risks for investment and doing M&A, you can look at my previous video. I discussed about the biggest challenges and risks you would face in the emerging markets like Vietnam, and I gave some real life companies examples, and also in the coming weeks I will also share the solution to those problems, and also my advices on solutions, and also more case studies, more details into the case studies of the Vietnam markets as well. If you have more opinions and views, please also comment into the comment section below, so that we can learn from your opinions and views as well. Okay, so that is for today. I hope you like the topic, and I hope it's you get something from this video and get some helpful information from this video. And also, if you find that this video would be useful to some of the people you know, then please share the video with them. And also please click the like button, so that I know that there is interest in this type of topic. So in the future I will prepare more videos related to this type of topics to share with you. And also subscribe to my channel, so that the future videos coming out you can get to watch as soon as possible. Okay, have a good day. Thank you. Bye bye.